the ones who make that kind of money are often going to be the ones that bear the brunt of a higher tax burden in the future. Then we know that the tax code is written in pencil. It's not written in pen. What typically happens is that higher income earner is asked to pay more of what may be deemed their fair share. All right, so let's talk about Roth conversions for just a few minutes because, this is a common thing that a lot of financial advisors may discuss, maybe even recommend. But one thing that we know is that as we enter into truly planning for income in retirement, it sounds really nice to have tax-free income, but how we get there may be different depending on your overall plan. One tool we use could very easily be Roth conversions. But for higher income earners, the ones who are making high income right now, maybe it's the height of your career, maybe you are already retired and you're seeing income come from pensions that you weren't used to receiving. Whatever that is, you've got to work that out in your plan to where you know if it makes sense for you to do Roth conversions now or to do some sort of different plan, maybe Roth conversions later. So what are Roth conversions exactly? Well, this is a real simple tool that we can use where we pick money up in what we call tax me later buckets, traditional accounts, and we move them to tax me never again buckets. This tax-free bucket has to be taxed at some point. Well, that's taxed on the transition from traditional accounts to Roth accounts. That Roth conversion becomes a taxable event in the time in which you do the Roth conversion. It is fairly simple. There are 5-year rules wrapped around that conversion to where you can't touch that money for 5 additional years or else you will incur penalties. But the scope of this conversation today is for those who are maybe making a higher wage now, should you do Roth conversions? And you've got to be able to build this into your plan to tell whether or not that's a good idea or a bad idea. So let's discuss a couple of reasons why you may want to do Roth conversions if your plan shows one of the following things. Perhaps it shows that you're going to be paying higher taxes in retirement than you currently pay today. You may be looking at your tax statement, you may be paying a 32 or 35% tax bracket right now. Maybe you're paying a 37% tax bracket, and you may think, man, I'm never going to make more money than I'm making today. But here's the thing, those higher tax brackets are under attack. What do I mean by that? The ones who make that kind of money are often going to be the ones that bear the brunt of a higher tax burden in the future. We are spending money as a country in a rate that we can probably never repay it if we continue down the same path. And we know that the tax code is written in pencil. It's not written in pen. And when it changes, and it often does, what typically happens is that higher income earner is asked to pay more of what may be deemed their fair share. So if the tax plan for you is to make the same amount of income that you make now or higher in retirement, even if you're at the highest possible tax bracket today, it may actually make sense that you consider future taxes and pay them now versus paying an unknown rate later. That's one reason why, considering future taxes. Another reason is to control when you pay taxes. See, a Roth conversion is not as much about not paying tax as it is determining when you get to pay that tax. If you have a known rate today versus an unknown rate in the future, well, it might actually make sense for you to go ahead and pay out your partnership with the IRS, which is silently what you have entered into when you put money into IRAs or 401ks. And a third reason would be estate tax planning. So thinking about your legacy when you get ready to leave this earth, who are you leaving this money to? If those individuals are responsible for paying tax on this money, does it make sense to go ahead and do conversions now, again at a known rate, as opposed to giving it to them at a completely unknown rate and with a restricted time frame in which they must take this account to zero? This could pass the burden on to them at a much higher rate than you would have to pay. For instance, if we're able to pay a 24 cents on the dollar or even a 37 cents on the dollar today, it might make a lot more sense for us to do it now at 24, say 32 or 37, as opposed to passing it to them at a 50 or 60 cents on the dollar bill that they would have to pay. Now, this has a lot to do with your estate plan. Of course, we help clients with that here at RDS Wealth and making sure that the legacy is also built into your overall plan. This all has to go into your decision as to whether or not Roth conversions make sense. which, if we look at the other side of the coin, there are some very key reasons as to why it may not make sense to do this type of Roth conversion. And the opposite is true about the first point of why you may want to. It may be the fact that you are not going to be making the same amount of money in your retirement years as you currently make, which is a reason why you wouldn't want to. If you're going to be making substantially less, or maybe that income source is going to be tax favored in some way, it may make a lot of sense for you to defer this Roth conversion or perhaps do no Roth conversion at all. All of this has to be built into your income plan, again, which is why we start with that at RDS Wealth. Our team also helps you understand the opportunity cost, which is reason number 2 as to why you may not want to do a Roth conversion. What do you mean by opportunity cost? Well, the money that you pay in tax now for that Roth conversion may be better off in an investment that is earning interest and compounding in its interest. How you pay the tax out of your Roth conversion matters. Many times people may decide to pay the tax for that Roth conversion out of the same account they're doing the conversion in, and it becomes a little bit of a stair step into a problem, if you will, where we're compounding the amount of withdrawals we must take to be able to truly do the Roth conversion schedule. In other words, we may be paying tax on money that we don't have to pay tax on, or even worse, not allowing that money that we're using to pay tax to grow in a compound fashion. So this could be something that works against you in your plan. Making sure that's not the case is a must. And a third reason that you may not want to do a Roth conversion now if you're a high income earner is the fact that it could trigger an unknown tax, maybe a hidden layer of taxes, things like surcharges on Medicare if you're over the age of 65. It could even trigger things like surcharges on Medicare if you're not over the age of 65, because think about this, your Medicare premiums for IRMAA are going to be determined by 2 years ago tax returns. So be careful, especially as you approach the age of 65 in doing these Roth conversions. It could unlock a hidden layer of taxes, surcharges, alternative minimum tax, a list of things that it could do. And you've got to make sure that this is in your income plan as well as your tax plan, and that those two are dovetailing together very nicely. If you see that Roth conversions make sense for you, there are some strategic times that it may make the most sense. First of all, I'm going to tell you, if you see Roth conversions making sense in your plan, do it while the market is low. If you see a sell-off in the market, do it then. And here's why. If you can convert a stock that's say $100 a share, you know the fair price on this stock is $100 a share, and I'm making a stock up, we'll say ABC stock. ABC stock is worth $100 a share, and now it's on sale for $50 a share. It's taken a 50% haircut in the market. It would be nice for you to do the tax Roth conversion on that one share at $50, only paying tax on that share for $50, moving it over to your Roth environment, then seeing the appreciation back to simple fair market value of 100, plus its capital appreciation over the years of holding it, and every bit of that is tax-free. You're getting a tax discount on solid assets that you intend to hold long-term anyway. Doing these Roth conversions in a down market, great opportunity. Another opportunity is doing a Roth conversion when you have experienced a lower than ordinary income. This temporary drop in income could come for many reasons. Perhaps you've changed jobs. Maybe you've taken a sabbatical in between those two jobs, and you know that you're going to have a little bit lower than ordinary income in this given year. Or maybe you've just seen business losses. Maybe you're a business owner and that's where you get your high income, and you see business losses in a given year. Be a great opportunity to do a Roth conversion. Now you may think, why would that make an opportunity for Roth conversions? Well, if you're at the, say, 32% tax bracket, let's just imagine now because of a change of job or a sabbatical or some sort of loss of profit, you're dropping down into the 22% tax bracket, or even better, maybe you're just at the 12% tax bracket. You can do a lot of Roth conversions for, again, a known rate that is substantially lower than you would have done it just a year ago. This is a great opportunity for you to take advantage of in your Roth conversion strategy. And believe it or not, one of the best opportunities to begin your Roth conversion is the year in which you retire. If your plan makes sense for you to do Roth conversions, and maybe we're trying to avoid required minimum distributions because we know it's going to kick us into a higher tax bracket, which is one of the primary reasons to do Roth conversions. If that's the case, then the year in which you retire may be a perfect opportunity because you're seeing a lower than ordinary income. Just be careful that you don't do too large of a Roth conversion and put yourself in a liquidity crunch, or even worse, maybe you run into that nasty 5-letter word, IRMAA. IRMAA is something we want to avoid in our Roth conversion strategy, and a proper tax plan can help you do just that. Now, I'm going to tell you, we help retirees with all of these plans. We build this retirement atlas to help them navigate the tax plan specifically, as well as how it dovetails with their investment plan, their income plan, their healthcare plan, which we've talked about IRMAA and how it coincides with Medicare and how much you're going to pay in Medicare, and the legacy plan. These 5 plans must work together if you're looking at your Roth conversion strategy specifically in a vacuum or in a very narrow scope. It's going to be challenging for you to know whether or not it makes sense. If you need help looking at it from a broader picture, a more holistic way of looking at Roth conversions, our team is here to help. We would be happy to shine some light on that, or even just be a second set of eyes on the existing plan you have today to make sure that good intentions don't lead to very expensive outcomes. We would love to help you, and we would welcome a conversation at a time that's convenient for you. Until we talk again, always remember, save money, plan well, and live happy in retirement.